When the market's doing well, that's the best time to evaluate both your risk tolerance and how much we might lose in the next stock market crash. That's going to be the topic of today's video. What can we expect to happen the next time the stock market takes a tumble? The average calendar year loss for the stock market on a total return basis since 1871 isn't all that bad. It's only 12%. Since 1871, we have had 39 negative years, and the average loss total return has been 12%. Doesn't seem like a lot, does it? A bear market is a loss of 20% or more in the stock market. That's the definition of a bear market. We have had 14 bear markets in the last century. We get a bear market about every 7 years on average, and the average loss has been 38%, far greater than the average calendar year loss for the stock market. And that's largely due to sequence of negative returns. Bear markets tend to last more than a year. You can see that the average duration for bear markets is 18 months, a year and a half. So when you have more than 1 year of negative returns in a row, you can lose a lot more money than you would ever lose in 1 year. I think the next bear market, whenever it shows up, is likely to see a loss of at least 30% or more. Let me show you my reasons why. We are at a very high valuation for the S&P 500. SPY ETF, the S&P 500 proxy, trades at 27 times earnings and only a 1.18% dividend yield. High price, low yield. This chart shows us the PE ratio for the stock market back to 1872. You can see that we are at a high valuation now. It's not the end all be all, but what I take away from this is that when you're at a high valuation, you have a lot more room to fall. We also have something going on in the stock market that has never been seen before. The concentration in the Magnificent Seven is so extreme, it makes 1929 and the year 2000 concentration look like a joke. As of December 2024, the Magnificent Seven had a market cap of 18.2 trillion. That's market cap to GDP of 63%. Its market cap to S&P 500 of 36%. They were more than a third of the S&P 500. It's crazy. And the group was trading at 51 times earnings. Very expensive. Again, when you're at a very lofty price and price to perfection, you can come down a lot and very quickly. So whenever we have the next bear market, or if something unfortunate were to happen to these stocks as a group, we could see an outsized influence on the S&P 500. Just like these stocks carried the S&P 500 up and up, they could take it down and down very quickly. Now, I'm not saying the Magnificent Seven stocks are bad stocks. They're not. They're wonderful companies. I'm just pointing out the risk here. When you have this much concentration in a handful of companies, if something were to happen to this group of stocks, they would have a tremendous negative impact on the stock market. There is a mind-boggling amount of money in passive ETFs, with more and more money flowing in all the time. Passive ETFs, i.e. indexes, just go out and buy whatever stocks are in the index. That means for every dollar going into S&P 500 index and various other index ETFs, they're just going out and buying all these stocks, further pushing up the prices. But what happens if we get a serious downturn? It will be very interesting to see. Unlike many years ago where there was a lot more money in actively managed mutual funds, ETFs, etc., now the bulk of the money in the stock market is in passive strategies. So when the managers for those passive strategies get sell orders, they can't go in and say, well, Microsoft's a good company and I would prefer not to sell it. No, they have to sell it. They have to sell everything. So it will be interesting to see what happens during the next major downturn. Will selling pressure in passive ETFs lead to a larger swing in price? If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.